The interesting point that Danny makes there is on stimulus and the effectiveness. Is that the main thing you think that's boosting markets right now, the expectation of stimulus? And if that misses, do markets fall?
Well, I think, first of all, the most important thing everyone's waiting for is the expected change in monetary policy in the United States. So I think, the China stimulus question is, of course, an important one, and it's already in and quite massive, and we think that this will be felt over summer. But the sentiment issue also within China, very much related to these trade uncertainties, and I think, a clear statement from the reserve currency of this planet still, from the US dollar, from the Federal Reserve, that this dollar squeeze is ending. That would be the major relief. So I think, the data are a bit jittery for that reason, because sentiment is very much subdued.
So everybody is basically waiting to see then what Jerome Powell says next week. And that is the most important, you think, the most important tradable piece of news for these markets really globally?
For the time being, yes. I think the story of the past 6-9 months has been all about the dollar squeeze. Of course, this was exacerbated by all the political noise, but in fact, there's just a major scarcity of the key reserve currency, and therefore it's so utterly important not only to stay neutral, but rather be supportive, being in the shoes of Jay Powell. So I think that this is the biggest thing, bigger than the G20, or possibly even bigger than any trade agreement. I think this is a real change, and is actually kind of extending the cycle and the bull market in financial assets.
Just because you're in Zurich, I think of the Swiss franc, and I'm looking at, if I take a look at it on PPP, for example, on our WCRS screen, I see the Swiss franc, even with the lowest, most negative rates in the world, is still overvalued against the dollar, one of the very few currencies that is. What do you think of this rush for safe haven assets? I mean, with the U.S. 10-year yield at 2.08 and gold trading at over 1350, the strength of the Swiss franc, does that have legs, that the safe haven rally?
I think it's typical for this stop and go markets, which is very much, the characteristic of markets at the end of the cycle, that you see these sudden stops, and we've just had one in May, and then you see all those assets moving heavily, and the Swiss franc is still one of the preferred safe haven places. I think, our expectation is that this will fade, that we'll see some brightening also with regard to the US monetary policy, and that this will then lead to flows out of these safe haven assets over summer. So possible that this will flare up again at some stage in the second half, but I think for the time being we've seen most of the strength of the Swiss franc short term, but also of other safe haven assets.